Hey guys, welcome to Real Job Optional Freedom. Real estate can be complicated. Let an investor guide you. We are here to demystify the complex nature of real estate by getting you answers from professionals who are in the trenches so you can be the hero to your real freedom story. Welcome to Real Money, a weekly segment of the Real Freedom Podcast where we ask the most pressing real estate questions. I'm here with my co-host, Kevin Gilbert, and I'm Chris Bell. And today we've got some exciting topics around real estate and what we're seeing as we try to put real estate deals together in the current economic environment, whether that's interest rates, whether that's working with sellers, all of the above. We're going to talk about that today. Kevin, what are you seeing?
Well, I think we're seeing a change in psychology, and the interesting part is everybody who plays with stocks, it's real quick. Everybody who's involved with real estate, it's a process for their brains to adjust to the prices. We're literally making offers, and we're putting a 2-week price tag. This price is good for 2 weeks because interest rates are changing. The last hike we saw was 0.75%, which is a huge jump when everybody's used to 3%. Just percentage wise, these are big numbers, right? So we're all coming from an environment where my offer is good pretty much indefinitely. The longer we wait, probably the more I can pay, to an environment where suddenly this number is good for 2 weeks and then it's going to drop. And the reason is as interest rates change, it changes all the math, right? You got to look at what people can afford monthly, and then the second that your interest rate changes, it affords what your own mortgage is going to be like instantly, right? And when you're playing with big numbers, it makes a huge difference. So there's some psychology around that, right? People are like, my property's worth $1 million, and you tell them, well, that was in January. Now I can offer $900,000, and it doesn't. They emotionally have not processed it yet. We're kind of seeing that across the board, from small residential houses to neighborhoods where, when times are good, flippers go into those neighborhoods. When there's less competitions, they don't even go there. They stick to the better neighborhoods. We're seeing it all across the market, and it's quick, right? So if you're not actively doing this stuff, you're not going to notice it. I'm talking like the last 3 weeks, kind of short term, right? So that's not enough time for people to process that. The values and the numbers that could sell a property for have changed so quickly. Some of this math, I saw a number where it said the median price last year for a house was somewhere around $1,400 a month, and now it's drastically, moving past 1900, like, a shooting star. So where's that number going to settle? We know and have been discussing minimum wage hikes, how that's affecting the entire market. The economy is changing, and we're seeing how that's affecting valuations on houses. So
Yeah, absolutely. I think one of the things, just hearing from one of the real estate agents that I work with, he helped a client who happened to be a doctor, basically buy, the doctor's next, $1 million house, and they wanted to sell the house that they were living in, but they wanted to have and acquire the new property before they put the old property up on the market. And in their minds, over the last 6 months, they had a number in mind for what they were going to be able to sell their house for, top of the market price type stuff. And lo and behold, what ends up happening is they buy the new house. They then list the old house, and crickets. Like no offers, no showings, no walkthrough, like nothing. So then they kind of get a little bit freaked out. The seller wants to pull the property off the market, thinking that there's, something wrong. Maybe it's the agent,
there's something wrong. All right.
Right. And, and then of course the agent's telling me, look, he had to explain to him that, the prices for money has gone up significantly. And ultimately, when you're talking about selling $500,000, $750,000 homes, that impacts people's payments ultimately, and that impacts, what people want to buy. So there's definitely having a big impact. And I think on the other side, what we're seeing on some of these commercial properties is how important the debt financing is and how much debt drives these deals. Like, so basically, your ability to get, I don't know, quote unquote, good debt, 2, 3, 4, now it's 5, almost 6
Give it a
percent
couple weeks.
interest rates. Yeah, right. That has a big impact on like multifamily cash flowing properties, and the the sellers on the other side. I mean, we saw it put an offer in, um, and basically it was a family that was trying to unload this property that I'm talking about, and instead of countering our offer, they decided not to counter the offer, and 3 weeks later, the broker of the complex is calling up and saying, hey, can you please resubmit that offer? Would you be willing to buy it at the same pricing? And essentially the answer is yes, so long as we can get the same debt financing that we could have gotten 3, 4 weeks ago. So it's really interesting to see what's going on in the market live, when you're trying to work through these things. So
Yeah, that particular number, we're looking at those properties, and it's like our number in January could have been orders of magnitude more because interest rates were 3%, right? And the doctor, like, if you're if you're basically pitching this house to the same audience who can afford the same payment, you know, just the difference in interest rates probably means he needs to come down 20% to get the action he's looking for, right? That what might actually happen is you come down 10% and it sells, but it's still like a mental adjustment, right? If you're expecting it to be $1 million, 10% is 100,000. It's big money, right? And it's a shock to the system. And when these interest rates change so quick, and there's a lot of expectations that it's going to go to 8. I I don't know. That might be a blip on the radar as we fly past it. I'm not sure where we're going to end up here, but there's a lot of change coming. The interesting thing about all this is if you're pricing it right and you get that loan locked in for 30 years, it's interesting because the numbers drive everything, right? So uh, I I remember talking to an older investor who was talking about when he started, interest rates were 18% and you still made money. And all it means is your number adjusts. You lock whatever that payment is for a long period of time. And if it masks at the interest rate you have locked in on that mortgage, the debt, like you said, drives whether the deal works or not, right? And rents go up years down the road, interest rates go down, everything normalizes, whatever, you refinance, it's fine. But if you can get the numbers to math today, lock in that rate, it you can tell what your return is going to be. You can literally do all that math and figure out just how good that deal is going to be for you. But you have to lock it in, right?
yeah, I think that's one of the interesting things too, is that so many people on the single family side, they're used to 30-year amortization, fixed interest rate mortgages, which are a huge competitive advantage to your single family homes and your 1, 2, 3, 4 complex 4 unit complexes. But then when you start going into commercial loans where you're going 5+ units, the debt changes. The banks look at it a little bit differently. A lot of the banks put 5 to 7 year balloon payments on things. The amortization cycle is not 30 years. It's 20 or 25 years. Like, so there's all these different variables that come into play when you're talking about the debt as you start looking at bigger deals. And then there's I mean, we've seen it. Some people we know that they basically bought a multifamily complex, or actually I should say they're in the process of buying a multifamily complex. They were shopping all of the debt on this complex, and lo and behold, the bank that financed the original ground up construction of the complex ended up offering them, local bank, offering them the best financing, the best terms, best amortization schedule, because the bank knew that that was a performing asset for them, and the bank is making a little bit of spread on that. They know that if they're getting money from the 3 or the 10-year treasury yield at, I don't know what it is right now today, but let's say it's 3%, and they can lock into somebody else to, offer them 4.5%. They're making 1.5% on that money, and it's millions and millions of dollars. You're talking, 10, 15, $20 million loans here. So the banks are really happy to keep that. It's almost like bond type, rate on their books. So
Especially if they believe that rents are going up, it puts them in a position of, just feeling safe, which is what the bank really wants. But you were talking about the difference between large commercial and single family. Is It's interesting because, you're like, well, what are the difference, right? One, the pool of buyers is drastically larger, right? Investors all want a deal. Single family homeowners, you might be like, well, grandma lives 2 streets down. I'm willing to pay a premium for that nobody else is willing to pay, right? So you got this larger pool of buyers. And then on the other side of that is, you're talking about up to fourplexes. The reason fourplexes are so popular is that's what Fannie Mae will insure. They'll insure a single family home, a duplex, a triplex, and a fourplex. The second there's 5 units, it's a different ball game, and you're talking commercial. And I've actually seen a fiveplex that was turned into a fourplex with this insanely massive unit, just so it would qualify for that very purpose. So it's interesting, you know, the big commercial stuff. You're not locking in for 30 years; you're locking in for 7, and it's still a math game. But it's just powerful. Like, I can literally have a property that is fantastic. I can buy in a market where I believe that everything's going down except the rent, and feel good about it, because if it maths at these interest rates and I can lock that rate in, then it's going to math for me.
you bring up a good point, Kevin. So you say, you feel confident that rents are going to go up, but let's talk about the contrarian side of that. Like, what happens in a real estate market that would potentially cause rents to go down, whether they go down a lot or go down a little? Talk me through some of that. Like, what are your thoughts on that?
So these are actually a lot of concerns that are coming up. We're seeing a lot of data that shows that rents are going up. We see a lot of stuff, right? But um, it's all based on this being a mild recession. It's all based on minimum wage getting straightened out. We're seeing a lot of inflation, and one of the lagging indicators for that is hourly wages for employees, and it's a huge problem. I mean, you type Google, there's 10 billion people talking about it right now, right? Um, One of the issues is we've been seeing for the entire pandemic times, there's problems with evictions, right? There's a moratorium. It's ending for us here in Virginia in the next month. So we expect things to go back to normal. So you're like, is that going to create a huge influx of units available? If jobs become a huge issue and people are facing huge unemployment, or there's basically, you're like, what trends are going to encourage a vast segment of the population to either just stop paying rent, or maybe we start doing a European style thing where there's 4 or 5 generations in all the households around you, right? So you're looking at all these factors that might lead to a surplus of inventory for rentals, right? Does the supply increase? I saw data the other day that there's 1.4 million units under construction right now, that are literally being finished as the market changes, right? So you're like, all right, these units are coming up. The moratorium is going to come up, and the people who have not been paying for 2 years, are going to be out of the units, and the landlords are going to be looking for new tenants. So you're looking at all these supply issues and demand issues, and there's a lot of factors to consider. So
Yeah, I think when you look at that too, because if typically if a property is being professionally managed, if somebody has been evicted from a property, the next professional manager will not rent to them because it's going to show up on their, their credit history. It's going to show up on the background check that the landlords are doing. So when you're looking at professionally managed units, those folks are either likely going to have to move back in with other family members, or a lot of times you'll see them basically skip to other states where when the landlord in the next state is pulling things, it may not show up on their credit or their background check. So you could see some migration patterns there. I think when you start having, I guess if you just look at housing and you say, hey, this whole thing is just supply and demand. Right now there is low supply and a higher demand, so it's pushing the prices of rents are still going higher, um, especially on properties that people desire or they want,
Yeah,
right?
that's such a tough one to measure, right? Like there's this huge pent up demand for properties, right? So let's say something comes along, and as part of this recession that causes the demand to drop. Like there is pent up demand. My brother has a wife who has a number of siblings, and they could not afford to live in our area. There's a number of cities, so they could not afford to live in Virginia Beach as a single mom with two kids, right? So they moved in with my brother and his wife, right? How many families are like that, where so you're like, in a way, that's pent up demand, right? She's not renting anywhere, she's staying with families. And the second the math works, the second her income goes up or the rents come down or whatever, she will find a place, right? And you're like, how much of that? And it's so hard to measure those kind of things, right? What does pent-up demand look like? We know right now that there's a shortage. We know that there's a huge demand. We literally had an Asian friend yesterday tell us that people are calling him saying, "Man, you got to find me a place to rent." Um, we know that there's demand there, but you're like, well,
Yeah.
what? We're going through a lot of changes, and
Yeah.
it's hard to measure these things. So
Well, we're seeing that too. Recently, a single family home on the market, 2,500 square foot, good area, cul-de-sac, nicely renovated. Um, looking for a two-year lease on the property. Um, 2,700, I think, is what it started out at. Almost 40 applications on the property. Almost unheard of. So like the demand is still out there for the quality product from the rental side. At least that's what we're seeing here in one of our markets. And I venture to say that even in other markets, kind of that supply and demand curve, until that balances out, you're going to continue to see prices go up on the rental side. I do think though, when you see, you say that pent up demand, it's basically this combination between uh, prices, so rents coming down and wages going up. So I think that's why it's so hard to measure that, is because you've got one side coming down and you've got the other side coming up, and it's where do they meet that creates that
right,
equilibrium
and
on the
and
supply and demand.
and one of the pieces to factor in is that we're talking about um, rents coming down. I don't know that I really believe the actual dollar amount will drop. Right, we're seeing a large number in amount of inflation. So, another benefit to a leveraged property is your mortgage is fixed. Right, so I feel, based on some of the data I've seen, and it's hard to math all this. So everybody's got an opinion, is where we're at here. But I feel like we're seeing a lot of inflation, so the rents are going through the roof. I don't feel like they're going to come down on a dollar basis. I feel like over the next 4 years, we're going to see wages go up. We're going to see the cost of a cheeseburger turn into $50. We're going to see all these other numbers go up, and rents will stabilize at some point. And as a percentage of an employee's income, it'll come down percentage wise, even though on a dollar basis, which is what you're basing your mortgage payment on, right? It'll feel like it's coming down, even though the dollar amount you receive is not less. The dollar value is going down on as a percentage of the world's purchasing
Yeah.
power.
Yeah, that's a great point, Kevin. I think that's, when you start looking at things from a percentage basis, it starts to make bigger sense. Because when you solely look at something as like dollars for dollars, it, it's skewed.
Very skewed.
It's almost like this magician, like it's
It's a magic
smoking.
trick.
Yeah, it's smoke and mirrors. But when you look at it and you say, hey, you used to, in 1970, you made $10,000 a year and 30% of that went to housing. Well, okay, so now in 2022, you make $1 million a year, but if 300 grand still goes to housing, it's still 30% of your income is going to housing. So,
And you're using those numbers, but I think we were looking at a chart the other day, 1968, the average American uh, earner, the average American person with an income, a household, if you will, was it was like 38% of your paycheck went towards housing costs, right? We saw that number go through the roof, right? I think the most recent number was somewhere around 88%, which really means to math, you need to have two incomes in the household, right? So that you get it to a percentage where you're not starving to death, right? And that's astronomical. That's kind of a multi-decade high. And I think with all this inflation, I think we're going to see that number come down as the government raises minimum wage and other numbers as a percentage on a dollar value. Like if you're staring at dollars, that chart's still going through the roof. But if you start looking at it as a percentage of what a household is bringing in, I'm expecting and kind of hoping the world normalizes uh, somewhere lower than where we're at with that
yeah.
88% number. So
So, Kevin, I don't know if you saw this, but I saw this a few weeks back. But I think it's Los Angeles County is now giving out like a base payment or some type of base wage to uh, a large percentage of their not a large percentage of their population. I think it was like 10,000 people or something. They're given $1,000 a month to basically try to offset, basically how much stuff cost in Los Angeles County. It was like it's like almost like one of those socialist programs. Not it wasn't Section 8 or anything like that, but it's along those same lines. It's almost like, hey, can we get you out of the tent on the street and get you into a dwelling if we give you $1,000 every month?
you know, uh, that's an interesting number because you were just talking about a percentage of housing costs, right? If you're struggling and your numbers are drastically skewed, as you find in Seattle and San Francisco, uh, you could be doing your best and turn homeless with these numbers, right? If you don't have a support structure where you can have a household of 3 or 4 people who are earning an income, right? So, yeah, we're entering a recession, and one of the things that's always interesting in a recession is that you can see the outliers, right? New York, California, Seattle, Florida, Vegas. You're going to see all these places. They're extremes, right? So in good times, they rise the highest as everybody takes advantage of low interest rates, and in bad times, they fall the furthest as everybody sells their second home in Florida, right? So it's always interesting to see those. And one of the things that's always interesting in the math is the homelessness numbers. Like they're through the roof. And it makes you curious to see if those numbers are going to change in the next 2 years. As you hope to see the percentages of income versus expenses on housing, among other things. Gas is through the roof right now as well. So
Well, what's interesting too, Kevin? Like I look back, I remember being a young adult traveling to New York City, traveled to San Francisco, and I remember I specifically remember New York City going to a McDonald's in the city, and the combo meal at the time it was like $9.25, somewhere in that
what?
ballpark. And what was crazy was where I was from. the combo meals were $2.99, you
Yeah, there's
know?
no
So
dollar meal. There's no dollar menu here. There's a $10 menu.
right. And then the same sort of thing was in San Francisco. I remember minimum wage nationally was $4.25. I'm in San Francisco seeing minimum signs posted minimum wage 9.25 an hour. So I step back and I look at this and I go, man, like here we are, gosh, almost 30 years later, right? And I'm going, these places have proven essentially that if you just bought housing and held on to them as wages increased, so did rents, so did the housing prices. Like it's
And not your
not
mortgage payment.
right. It's not rocket science that it can happen in any other market. And I did just look up this LA County's guaranteed income program. It is 1,000 eligible Los Angeles County residents will receive $1,000 per month for 3 years, Kevin.
Yeah, that's an interesting way to try to alleviate the homelessness program. Is you're talking $1,000 times, what is that? 36 months, right? So
Yeah.
36 grand per person.
Yep.
That's
So you wonder
yeah.
though, in that situation, obviously they're probably giving it so some of the people that are homeless there in the streets. But is the $1,000 enough to put a roof over somebody's head in Los Angeles County, or is that essentially giving them money so they can move to another economic zone where maybe they can afford to work, make a living wage, and live?
Right, right. Yeah, the outliers in times of change are always interesting to watch, right? And I think San Francisco and Seattle are definitely on that list right now. I'm curious how this plays out over the next couple of years. We're going to see a lot of changes over the next couple of years, that's for sure. So,
Yeah, absolutely. I think we're already seeing some of it. If you really dig in and you read some of the headlines, we're already seeing layoffs happening because so right now we're at like record low unemployment, and you're kind of seeing some of these tech industries, whether it's Tesla or whether it's Carvana or all kinds of tech companies, they're laying people off, and a lot of times those jobs are high paying jobs. So where that employee base is at, wherever it may be in the country, those individual markets could have a bigger negative impact on those local economies. And I think like you always hear, real estate's local, 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 and it's so true. And the other, sorry, it's location, 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 but it's local, 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 right? Because you've got economic drivers to these markets. And what are the economic drivers to the markets? And if those industries get hit hard and there's big layoffs, well, that hurts markets.
so this is why anybody who makes predictions is full of it, right? Is because there's so many factors. It's hard to know. You can do estimates, you can run models, and we're all trying to do our best to figure out what the future holds. But you know, I saw a number where up to 40% of the S&P companies are not sustainable in a high interest environment, where it's possible that a very large percentage can literally go completely bankrupt because they're all requiring, they're funding operations out of low interest loans and equity, right? And in a recession, people stop putting money in the market if they don't pull it out just to survive, right? And the low interest loans disappear, so all these companies are suddenly cash strapped, right? So you're like, well, how do you factor in, how do you know, right? We're talking about layoffs in tech companies, but you're like, how many companies out there, not just on the S&P that are, national brands, but how many are out there and suddenly their business model doesn't work in a environment where interest rates are double digits and, you know, involvement in the stock market is, the cash is flowing out of the market instead of into the market, right? So anybody who's telling you they know what the future holds is full of it. But boy, we got a great track record with real estate, and one of the reasons is if you look at the numbers on leverage, right? If you're leveraging a property 80% and you lock in a return right now, let's say you're getting 6%. It's interesting because you can run that math and you say, all right, I want a 15% return. My offer is going to be this number. I'm okay with the 12% turn. My offer is going to be this number. And you can make offers based on that. And in the next 2 or 3 years, there's going to be a lot of sellers who are open to offers. So it's always, I just love this stuff because you can literally run those numbers and take advantage of the interest rates you're getting. And as times change, interest rates go up maybe a decade from now. You look at your numbers again and refinance that loan if you can get a better deal. It's fantastic. I love this stuff. It's a way to leverage your options, and man, you can become very rich doing this stuff if you figure it out. So.
Yeah, absolutely. And I think one of the things that's really interesting, Kevin, is you talk about if the deal works, even in a high interest rate environment, basically if it's cash flow, ultimately you may in the future, nobody's got a crystal ball, but you may have this opportunity to refinance at a better interest rate, right? But the other thing that kind of goes unsaid is if the deal works at a high interest rate and you can work to pay that loan off in a faster time period, you could have free and clear property even in a high interest rate environment. You definitely have the opportunity to refinance if things go lower. And then the other side of that too is it's that saying, right? Like if you pay a property off, you paid $100,000 for it, you pay it off. Let's say you do it in 15 years, and let's say it's still worth the same $100,000 15 years later. You can refinance the property at whatever the banks will give you, like 70, 75, 80% loan to value. And the money that you pull out of that property is tax free to you. You still retain the underlying asset.
If you have not sold the house, that's borrowed money, right? You're just restructuring. Yep. I love it.
So you get huge tax advantages for basically doing a refinance, cash out. You keep the asset, the tenant's still paying the thing down. You can deploy that capital somewhere else. You can pay for your kids' college fund if they're not paying for it themselves. And you can do all kinds of things with that capital. You can retire on it. You can use it to live tax-free.
I got one more thing to talk about. In 2008, right? All the things we're talking about fell apart, right? Why would that not happen this time? And I think there's a couple of things to point out about that is we've only had two environments where real estate prices really crashed, right? One was 100 years ago and the other was 2008, right? And I think there's a couple of reasons for that, right? 2008 was a real estate bubble. I saw some numbers 6-8 months ago, so we're talking a different environment, a different world, a different market, but it said there was more equity than Americans had for decades. I think the number was 40 years, but I don't really remember.
I saw it recently. It said 11 trillion in accessible equity.
So right. So that means there's probably borrow, more. Right. Yeah. So if prices fall, accessible, let's say the bank's willing to lend you 80%, right? So you're talking those trillions of dollars are under the 80% equity in our market right now. So that means there's another 20% that Americans have. So if prices fall, so these are the kind of reasons where you're like, 2008 was a real estate bubble. This is a issue of inflation. This is an issue of other economics. Real estate's going to be a victim or a chance to take an opportunity out of that environmental change, right? It's not the cause, it's going to be an effect, right? So, I'm seeing expectations of a recession. I'm not seeing the end of the world, but I'm sure everybody said that in 2007 as well. So it's all hard to know, but I can tell you personally, I'm buying, and some of the things we we're just talking about, you're saying if the deal works in a high interest environment, well, guess what? When you go to refinance in a low interest environment, the deal works even better, right? And if you bought last year and you had a low interest rate, well, guess what? That deal works phenomenally in a high interest rate environment, right? Because you're seeing all the numbers go up and your payment's still dirt low. So it's one of the reasons people always talk about the best time to buy real estate was yesterday, and the next best time to buy real estate is today. Is it's because all these if you can get the numbers to work today when you buy the house, and changes come 99% of the time, those changes are somehow advantageous to you, right? They open the doors for opportunities for you to do better. Either the refinance, get a new loan, get some cash out tax free, or your payments are going up while your payment to the mortgage company is staying low. There's just so many advantages. I'm always amazed when, like, I have some houses I bought 3 years ago, and I remember thinking about how marginal they were, and now they're fantastic deals as the market changes, right? And it's amazing how many times I've looked back on a house and been like, man, I'm glad I bought that, or man, I'm really sad I sold that one. Look at it 10 years ago, right?
I gotta tell you, Kevin, the only time I've been upset in real estate is when I did not keep a property.
Yeah.
Because hindsight is always 2020, and every time, whether that's I wholesaled one to somebody, or whether it's fixed it up, flipped it, or whatever, every time I've been unhappy, it's because I sold a property.
The problem, though, Chris, is for me and you, this was our business. So we had to eat, we had to put food on the table. But yeah, you always look at them later and you're like, man, if I figured out how to keep it, right? Uh, yeah, I know for a fact some of my best deals came from wholesalers, from investors who were new to the business and they needed cash now. They had to eat, right? And I was in a position where I'm like looking at the long term. And those are some of the best deals I've ever gotten, where, they got a check, they got 10 grand, they got whatever. They were happy that day, but decades later,
they got one-time money.
Yeah. Decades later, I'm getting a check every month. And on an annual basis, those properties, each one will pay me more than they got as their check, right? So,
Absolutely.
so you're right. I want to keep them all. And, some of the saddest moments is when you look back, you're like, man, I threw money away.
I literally drive neighborhoods and I'm like, sold that one. And I'm like, I
need some ice cream. I'm gonna go cry to myself now, right?
Yeah, because I'm like, you know what they're worth now? And of course
right.
they're always worth way more.
So imagine if you're not a professional in the business and you just buy one and keep it. Well, every time somebody tells me that they're happy they bought a property, my answer is always, imagine if you had two. So
yep, absolutely. Guys, if you are liking this content, please give us a like, smash that like button, subscribe to the channel so you know when we post new content. We're posting content every week here, and we'd love to hear your comments below. What are your thoughts on the current market? Did we get it right? Did we get it wrong? Let us know.
Oh, we'll find out a year from now.
Take care, guys.